If you own physical silver inside a retirement account and you are getting close to age 73, there are some major changes you need to understand. Most silver IRA owners think their precious metals are protected from the normal retirement account rules. But that is not exactly true. When you reach 73, the IRS rules around your silver IRA change, and if you are not prepared, it could lead to unexpected taxes, higher costs, and retirement mistakes that are difficult to fix later. In this video, we will break down the 5 biggest changes every silver IRA owner needs to know before turning 73. You will discover why these rules affect physical silver differently than many people expect. One IRS-approved option that may allow you to meet your required distribution without selling your silver. And strategies that can help you avoid unnecessary financial damage. This is not about silver being a bad investment. Many people choose precious metals because they want something real and stable for retirement. The problem is that retirement rules change as you get older, and the IRS does not always make those changes easy to understand. So today, we are going to simplify everything. Welcome to Silver Scenario, where we break down retirement rules and precious metals information in plain English. Before we continue, remember that this video is for educational purposes only and is not financial or tax advice. Always speak with a qualified professional before making retirement decisions. Now, let's get into the first major change, the biggest surprise for many silver IRA owners is that the IRS treats physical silver inside a self-directed IRA the same way it treats other traditional retirement accounts. Once you reach age 73, required minimum distributions, also known as RMDs, begin. This means you can no longer leave your retirement account untouched forever while avoiding withdrawals. The IRS requires you to take a minimum amount out each year. The calculation is based on your account value from the previous year and an IRS life expectancy factor. Many people believe that because their retirement account contains real silver bars or coins, different rules apply. But that is not how the IRS sees it. Physical silver may be different from stocks or bonds, but inside a traditional IRA, the distribution rules still apply. That means if your silver is stored in a retirement account, you need a plan B for your 73rd birthday arrives. Waiting until the last minute can create unnecessary problems. Now let's talk about the second change. And this is one that many silver IRA owners never hear about. When people first learn that they must take required minimum distributions, their first thought is usually, I have to sell my silver. But that may not always be the only option. Many people assume their silver has to be converted into cash before they can complete their required distribution. However, there is another possibility called an in-kind distribution. In-kind distribution means you may be able to take the actual physical silver itself instead of selling it first. Instead of liquidating your silver bars or coins and receiving cash, the custodian may transfer the physical metal directly to you. You still have to follow IRS rules, and the value of the silver on the distribution day can be taxable. But the difference is important. You are keeping the actual silver instead of selling it back to a dealer. Why does this matter? Because selling silver inside an IRA can create extra costs. You might buy silver at a premium, but when you sell, the dealer may offer a lower buyback price. That difference can reduce the value you receive. With an in-kind distribution, some silver owners prefer to keep control of the physical asset instead of turning it into cash. The important thing is that this option usually does not happen automatically. You may need to specifically ask your custodian about it. Many people miss opportunities simply because they do not know the question to ask. The third change is where things get more complicated. The IRS allows some people to delay their first required minimum distribution until April 1st of the following year. At first, this sounds like a benefit. It gives you more time, but there is a hidden problem. If you delay your first RMD, you still have to take your second RMD before December 31st of that same year. That means you could end up taking two distributions in one calendar Your and both distributions count as taxable income. This can create a temporary income spike that may push you into a higher tax bracket. It could also affect other parts of your retirement finances, including certain deductions and Medicare-related costs. The problem is that one decision can create consequences years later. A move that seems harmless today might increase your costs in the future. That is why planning before age 73 is so important. Instead of automatically delaying your first RMD, it is better to calculate how that decision affects your complete retirement picture. Sometimes taking the first distribution on time can prevent bigger problems later. The fourth change is something every Silver IRA owner needs to take seriously: missing your required minimum distribution or withdrawing less than the required amount can lead to penalties. In the past, these penalties were extremely high, and even today, making a mistake can still become an expensive problem for Silver IRA owners. This issue can be more complicated because physical metals are not as simple to value as stocks or cash. A stock account has a clear market price that changes every second, but physical silver depends on different factors: the type of coins or bars you own, current silver prices, and the valuation provided by your custodian can all affect the calculation. Even a small mistake in calculating the value of your silver could mean you do not withdraw enough. And if the IRS determines that your distribution was too low, the penalty may apply to the amount you failed to withdraw. The safest approach is simple: do not guess. Get the official year-end value from your IRA custodian and make sure your RMD calculation is accurate before taking any action. A few minutes of planning can prevent a very expensive mistake later. The fifth change is one of the most useful strategies for people who have more than one traditional IRA. Many retirees have multiple accounts. Maybe they have an old employer retirement account, a rollover IRA, and a self-directed Silver IRA. The IRS requires you to calculate the required distribution for each account separately. But here is the important part: you may not always have to take the withdrawal from the same account. In many situations, the total required distribution can be taken from another traditional IRA account. This can create a powerful option for silver investors. For example, if your Silver IRA requires a distribution, but you also have another retirement account with cash or traditional investments, you may be able to satisfy the requirement from that account instead. This means your physical silver can potentially remain untouched. Your silver stays in the vault. Your coins and bars stay where they are, and your IRS requirement is still completed. This is one of the biggest reasons planning ahead matters. The best retirement strategies are usually not about avoiding rules. They are about understanding the rules and using the options available. Summary: so let's put everything together. When you reach age 73, your Silver IRA does not escape normal retirement rules. Required minimum distributions begin. Your physical silver may have to be distributed, but selling it is not always the only option. Delaying your first RMD can sometimes create a larger tax problem. Incorrect calculations can lead to penalties, and if you have multiple retirement accounts, there may be ways to satisfy your requirement without touching your physical silver. The biggest mistake is waiting until the deadline. The earlier you understand these rules, the more choices you have. Before you go, ask yourself this: do you know exactly how your Silver IRA will be handled when you reach 73? Many retirees spend years building their retirement savings, but never create a plan for this important stage. If you know someone who owns silver inside a retirement account, share this video with them. The right information at the right time can prevent costly mistakes. Thanks for watching. Stay informed, stay prepared, and I'll see you in the next video.